this lesson, we are looking at one of the alternative systems of budgeting, and this is rolling budget. Rolling budget, also known as continuous budget. I'll take you to the screen, and then what we'll do there is to look at the theory behind rolling or continuous budget, and then there are two questions to go through, and then to confirm the issues around rolling or continuous budget. So by way of introduction, on page 3 of the online class notes, there are 5 bullet points there. Let us go through them one after the other. Now, traditionally, budgets are prepared on an annual basis. After the annual budget is approved, it is usually set in stone and not updated during the period. Okay, so what we are saying here is that traditionally what businesses do is to set a budget for the next 1 year. Setting the budget in stone simply means that once the budget has been set for the year, all we do is to wait for the year to end. Then we look back and compare this budget with actual results. Remember, budget is a control technique that is used by management, so that we then go back and say, we now compare what actually happened with what was expected to happen as per the budget. Okay, that's traditional, that's how budgets are prepared. But then the second bullet will tell us that there is normally a problem with that. In other words, that works only in some cases. So bullet point number 2, this is a useful approach for controlling a business in a stable, mature industry. You know, in mature industries, little happens in terms of significant change. So then if you're in a mature industry where things can be stable over a very long time, then it would not be necessary to do any changes to the budget that was set at the beginning of the period. Okay, but then a lot can happen in 1 year which can render the annual budget obsolete and irrelevant very early in its life. A lot can happen. For example, competitors can launch new products which you did not anticipate when you were setting the budget. Consumer demand can change, okay, and costs can fluctuate. Things can happen to your supplier, and your major supplier, I must say, and then what will happen is that you are forced to look for alternative suppliers. This can happen just very early in the year. What we are saying in this lesson is that are we going to say, because we set the budget, even if we have seen significant changes very early in the life of the budget, we will say that's okay, we will leave it to be as it was set up to the end of the year? Obviously no. What it will mean if we did that was to say that yes, we've seen that there are changes that we didn't anticipate, but we will leave it as it is. We can't set the budget in stone for some businesses, especially those businesses that face a lot of volatility, a lot of things that can change over time, which are not anticipated. Okay, this is where rolling budgets come in, and point number 4 says that rolling budget approach is a solution to the above problem. Okay, so then what is it? What is it when we say rolling budget? This means that the budget will be updated more frequently than annually, either quarterly or even monthly, and a new budget period will be added to replace the expired period. So this very last point tries to explain the concept of rolling budget. So I'll try to explain it very simply. Now, let's say that you set a budget for 1 year period, January to December. Let's imagine that just after the first quarter, you realize that something significant has changed, and which will render the remainder of the budget for quarter 2, quarter 3, and quarter 4 not very valid, okay, or relevant to your new circumstance. So what you then do in a system of rolling budget is that you now consider new assumptions, and then based on what has actually happened in the earlier period, in my example quarter 1, you are now going to revise the budget for the remainder of the year. Okay, now when this happens in a system of rolling budget, what you're going to do is that for the period that has just ended, say quarter one, once you change the budget, you revise the budget for quarter two, quarter three, quarter four, you add on a new period that will replace the expired period. Now, when this goes on over and over again, it means that at the end of every quarter, we're going to have a new budget for the next 1 year. Okay, we're going to have a new budget for the next 1 year. So this is where we say that you are continuously updating your budget. Okay, no wonder rolling budget will also be called continuous budget. Okay, now for the purpose of the exams, you've got to be able to explain what rolling budget is. You've got to be able to advise whether in the circumstance of a particular company in front of you in the exams, whether the use of rolling budget is important or not, whether the use of rolling budget is relevant, is useful or not. Okay, so you look at the circumstances of the organization. Normally, when the organization is in an environment that changes so often, things change so often, then you recommend rolling budget. Okay, now in this lesson, we're going to look at two questions, one of which was a past exam question which the examiner flagged as having been poorly done globally. So we'll be looking at this. Once we finish with the numbers, the advantages and disadvantages of the budget system, rolling budget, will come naturally to you, and we'll then explain that. Okay, so let's go to the first of the two questions. So here we have it on page 4. Example 1, Metisco uses a system of rolling budgets. The sales budget for the year to 31st December 20x9 is as follows. So you see the year 20x9, for the purposes of budgeting, you can see that has been divided into 4 quarters. Okay, so based on whatever assumptions there was at the time, the budget for sales figures you can see here for quarter 1, $485,000, up to for quarter 4, $569,507. So for the whole year, sales was budgeted at $2,105,999. Now, actual sales for quarter 1 were $462,300. The adverse variance is explained by the actions of a new entrant into the market who reduced prices, and Metisco was forced to reduce their own selling prices too in response. I'm sure this should sound like a familiar story to you. A new entrant has come with actions that you naturally have to respond to, otherwise you will be kicked out of business. Okay, so that is why when we budgeted to sell $485,000, we only earned $462,300. This was where the variance is being said to have happened. Now, the revised assumption for quarterly sales growth is now 2% only. All right. Required, update the budget for quarter 2 based on the above information. All right. So it means that had it not been for the action of the new entrant, we were expecting sales to grow by more than 2%. Now, if you do a quick check, which is really not very much required for the solution, but just for the sake of understanding, if you check the change from quarter 1, $485,000 to $511,675, you observe that this is a 5.5% change that was anticipated. Okay, percentage changes, you should be comfortable with finding them in the exam. So, for example, I can confirm to you that when we take the new quarter 2, 511,675 divided by the old quarter 1, 485,000, and we subtract 1 from that, you're going to get a growth of 5.5%. Okay, so if you like, you could test the growth from quarter 2 to quarter 3 the same way. Quarter 3 divided by quarter 2 figure minus 1. If you want to check the growth from quarter 3 to quarter 4, you take quarter 4 figure for sales divided by quarter 3 figure for sales. If you did all of this, you realize that in the budget, we anticipated a 5.5% growth. However, because of the actions of the new competitor, growth is expected at only 2%. Update the budget from Q2 based on the information above. Okay, so here we will have our solution. Q1 has expired, so we're just going to have Q2, Q3, Q4. Don't forget, per the question, this is the year 20x9. So in a system of rolling budget, we go to add on Q1 of the new year. And I can think about this. This could be the year 20y0. Okay, so then how do we roll the budget? All we'll say is that for Q2, we're going to say we had an actual sale in Q1 of 462,300. What we'll do is to grow this by 2%. How do you grow a figure by 2%? Alternative ways of doing it, but my preferred approach would be to just multiply by 102%, which will be 1.02. Okay, 1.02. Once you did that, you're going to have a new budget for Q2, which will be 471,546. Okay, this 471,546 is also grown by 2% to give us 480,977. For Q4, the budget is going to be the Q3 sales budget of 480,977 times 1.02. I'm only growing the previous quarter's sales by 2% to arrive at the budget for the new quarter. So that will give us 490,596. For Q1 of the new year, $490,596 is going to be grown by 2%. So that will be times 1.02. And that will give us 500,408. Once all these are added, we have a new budget for a new year of 4 quarters, $1,943,527. So update the budget for Q2 from Q2 based on the above information. What it means is that these figures we've gotten are now the revised budget for the next 4 quarters. All right. So you see, this is what we will do at the end of Q1 when we realize that something that we did not expect, like in this example, the entrance of somebody new who has forced us to also reduce our prices. Okay, otherwise we wouldn't sell. This is what we will do. Now, when Q2 ends, we'll review the situation again, and if we realize that something has happened again outside our control, and then we did not anticipate it, we will revise the budget again for the next 4 quarters. Okay, so this is what you keep doing, so that at every point in time you have a budget for a full year. All right, so this answers example 1. Okay, now example 2 appeared on the exam for performance management at September 2015. This was one of the 2 questions at the time that the examiner flagged as having been poorly done at the time. So let's have it. For 2 marks, candidates were asked, what estimate for total annual material purchases should be recorded in the updated budget? Very important to read your question requirement carefully and clearly. What estimate for total, here we have it, total annual material purchases should be recorded in the updated budget? So let's have the question. BCO produces quarterly rolling budgets and had forecast the cost of material purchases for the next 4 quarters. That's Q1, 2, 3, 4. Purchases for Q1 were budgeted to be $220,000 here. And it was anticipated that the cost of materials will rise at a rate of 2% per quarter. All right. At the end of Q1, 3 things happened. Actual material purchases were recorded at $210,000. So you can compare $210,000 to 220,000. You realize that we saved some money. This was due to a change of material supplier during the quarter. Okay, so obviously we found a more favorable supply of material in terms of price. Now, a revised estimate for the increase in material purchase cost was made. The rise was now predicted to be 1% per quarter. So you see, we initially predicted 2% increase in material purchases. Now it's only 1%. Probably we found a new favorable supplier. Okay, the budget was updated. What estimate for total annual material purchases should be recorded in the updated budget? Okay, so we are looking for the new budget for the new year. Okay, so what we'll then do is to stand on the actual material purchase for quarter one, which was $210,000, and say quarter two is going to be $210,000 to be grown by 1%. So that will be times 101%, or if you like, 1.01. Okay. All right. So 210,000 grown by 1% will give us the revised budget for quarter two, 212,100. For quarter three, 212,100 will be grown by 1%. Same maths, okay? And that will give us 214,221. Quarter four, 214,221 will be grown by 1%. Same maths. And that would put us at 216,363. Do not forget, a new period will be added in the system of rolling budget to replace the period that has just ended. So this is quarter one. So for quarter one of new year, whatever that year is, 216,363, all right, will be grown by 1%. That's same maths, and that will give us 218,527. All right. It's very important to read these objective test questions carefully, because you are either getting a 2 or you are getting 0. Okay. What estimate for total annual purchase price? For the total annual purchase price, we're going to have the 4 added, and that will give us $861,211. Okay, $861,211, and that will give us answer C, option C, to pick as our correct answer. All right, so that is it. Now, with the two examples, what happened was that the new expectations now gave rise to increasing the budget figure by a certain percentage. In the first example, by 2%, and the second one by 1%. So you saw what we did with the maths. It could also be the other way around, that what we've now seen at the end of the first period proves that certain figures have to be dropping now. So if, for example, in the rolling budget, the figure has to drop by, say, 2%, then you know what to do. The maths will be that you now multiply the figure by 98%. If it's going to drop by 5%, then you multiply by what? 95%. Okay, so we've just gone through two questions. What has happened in these two questions is that with the first one, we were rolling the budget for sales. In the second one, we were rolling the budget for purchases. You could have a complete question where you have to roll budget for 5 line items, and this is the same principle. What happened actually at the end of the earlier period, you now use the new assumption to create new figures for the remaining period. And don't forget, you add a new period that will replace the expired period. So now, what happens is that from these figures, we can now deduce the following advantages and disadvantages are obvious, okay? The following advantages and disadvantages are obvious. One, a system of rolling budgets reduces uncertainty. You know, one of the problems we have in budgeting is uncertainty. So when a period has expired and you realize that something that was uncertain proves itself in one way or the other, you now change your old budget. So what it means in that case is that to some extent, uncertainty is being reduced by rolling budget. Number two, up-to-date budget always available. So there will be always budgets that are up to date as much as possible. Don't forget, number 3, realistic budgets are better motivators. Okay, so when managers know that they are going to be assessed, their performance is going to be assessed based on budgets that everybody knows is realistic, they are more motivated to achieve results. Okay, but the downside is that it involves more time, effort, and money. You can imagine every time trying to see new things that have happened and changing the budget. Okay, it involves more time, effort, and money. In public sector organizations, for instance, can result in the bulk of funds spent on budget committees and administrative staff. Okay, so in public sector organizations, for example, what can happen is that if we don't take care, a lot of the funds will be spent on those who prepare the budget. Okay, they're going to sit at meetings, they're going to attend conferences, they've got to do a lot of research to find out the new things that have happened, and that could consume a lot of money for the organization. Okay, number 3, clear wastage of time and funds when the organization is in a stable environment and already has accurate budgets. So we said it at the beginning of this lesson. When you are in a stable environment, things are not so volatile, things don't change so often, we can assume that your budget figures would already be correct or close to correct. You understand? So if you're in a system where things don't change so often, trying to use rolling budget could be a clear waste of funds, a clear waste of time. Okay, so that is it for rolling budget, also called continuous budget. Thank you.